how do we get a read on this tricky market now that the Federal Reserve has lowered the boom on us again, with J. Powell coming out last Friday and vowing to hit us with as many rate hikes as it takes until the beast of inflation is finally slain? We had an amazing rebound from mid-June through a couple weeks ago, in large part because Wall Street got too negative in the spring. We thought inflation would be endless, and we thought the Fed would have to crush the life out of the economy in order to beat it. Since then, we've gotten some real positives on the inflation front, like crashing commodity prices. Hey, how about these inventory gluts showing up all over the retailers? The mall is glutted. But as I told you last week, some investors were getting ahead of themselves, assuming the Fed would start going easy on us, even though wage inflation, which is what we're focused on, remains very high, and Powell has every reason to keep tightening because of it. Now that the Fed's given us a reality check, it's time to recalibrate. We hear a lot of commentators talking about how this charts this year look appallingly like the rerun of 2001 or 2008. Two terrible years for the market. Remember, we debunked those last week. I don't buy those analogies. In 2001, the market got pulverized by September 11th. In 2008, about the same time of year, we got hit with the Lehman Brothers collapse that triggered the most acute phase of the financial crisis. I know anything's possible, but I really don't see anything remotely similar lurking here. Sure, Powell's got to keep tight. We all agree. And that will slow down vast swaths of the economy and could potentially cause a nasty recession. That's not remotely similar to the financial crisis, though. Right now, we're looking at a garden variety rate hike. It's not great, but given how low unemployment is right now, it's not the end of the world either. I've lived through many of these, and there's almost always a way to make money when the Fed is tightening. You just got to know where to look for it. And that's something that we do here on Mad Money. Now, if this year isn't a remake of 2001 or 2008, how about a better analogy? Tonight, we're going to do just that by going off the charts, once again, with the Titan, with Larry Williams, the legendary technician and market historian who's been at this game since I was a teenager. Now, Larry's written more than a dozen books, and he's created tons of his own proprietary indicators, which you can find on his site. I want you to take this down because it really is pretty amazing. It's called ireallytrade.com. Most importantly, this man's record with us, it's stunning. It's stunning. He made a series of the best contrarian calls I've ever seen. He called the COVID bottom in April 2020. Most of Wall Street still thought the sky was falling. He called the latest bottom earlier this summer when everybody was convinced the price of oil was headed to 150, where it would kill the whole economy. He knew otherwise. What does he see now? Well, you're going to love this. Can we find a historical analog for the current market? This guy is the master of looking at the history of the market and spotting patterns or cycles that tend to repeat themselves. We believe it in sports. We believe it in art. We believe it in this. This time, nature's got it all over the place. This time, he set out to find the best fit for the last 250 days of market action, looking for analogs from 1990 forward using timing solution software. Using the years since 1990, Williams found that 14 of them were good forecasts. That's 42%, catching the trends, most turning points or prior years. 11 of them were just total failures at forecasting at all the next year's trend or even pivotal moments. That's a third. Finally, 8 of them, or 24%, were so-so forecasts, equal parts correct and incorrect. In short, looking for historical analogs, almost 60% of the time, they failed to correctly forecast the market's action in following years. Sometimes, though, they work like a charm. For example, take a look at the daily chart of the Dow Jones Industrial Average in 2018, dark line, okay? Turns out the year 2000 was a 40% fit to 2018, meaning it picked up a lot of the changes in the market's trajectory. Remember, 2000 was the dot-com collapse. 2018 turned out ugly turned out right at the end when J. Powell vowed to raise interest rates aggressively in order to stamp out nascent inflation. So these are good overlaps. If you extrapolate it from there and took your cue from 2001 to 2019, you picked up some important turning points. Take a look at this one. Next, you can see my turning points. See, these catches a lot of them. Next up, check out the action in 2020 when COVID hit, which is in black compared to the action in red in 2009 when the market bottomed during the financial crisis. You can see the correlation was incredibly powerful. Williams says there was a 77% fit. Makes sense. Both years saw the market collapse in the first quarter, only to find a floor in March and then rebound nicely for the rest of the year. So let's say you extrapolated from there and used 2010 as a forecast for 2021. Take a gander. Again, surprisingly close in terms of nailing important turning points, and the overall trajectory is pretty darn close, too, isn't it? I bring these up because you need to know that when this kind of methodology works, it really works. All right, so how about the current moment, which is what you've been waiting for? Williams says the closest analogy for 2021 was actually 2013. Take a look. Last year is in black, 2013 is in red. That's a 95% fit, practically lockstep. So if we push that forward, could this year turn out to look like 2014? When you look at the comparison, the overall trajectory was much more positive in 2014. But there's also some real overlap in terms of important highs and lows. After running in June and July, the market took a big hit in August of 2014. Not unlike what happened last week, right? And then it took off again through the end of the year, with the exception of that short, sharp pullback in October that we're going to have to be ready for, people. You know that's coming. And that was, you know what this was? And why I don't think it's going to duplicate. This was the Ebola scare, okay? Now, we're not going to, well, hopefully you don't have another Ebola scare then. But that's what caused that big decline. If Williams is right that we can be taking our cue from 2014 here, that's surprisingly positive. Much better than 2001 or 2008 analogies that we hear constantly. In other words, I look at this and I think, you know what, this makes more sense in 2001, 2008. And if it's so, then I like where we are. I think we're at a good level to buy. However, if you want an even better fit for the action, get this. Williams says it's 1962. Take a look at the Dow's recent performance is in black, while the 1962 performance is in red. Can you believe this? Might as well be joined at the hip. And once again, the 1962 analogy says we could have a very nice run in November and December after some sideways action. And again, that turbulence that we're so worried about in October. Finally, if you want to see something really eerie, I want you to suspend your animation for a second. I want you to check out this one. The Dow's recent action is in black, while its action in 1891 this guy likes to go back, is in red. Once again, the closest historical parallel Williams can find suggests that we have pretty good time at the end of the year, okay? So I know this is just, for some of you, it's hocus pocus. For me, I think it's gospel. I love it so much because the guy's been so right. Larry Williams, I really trade. Here's the bottom line. These historical analogs tend to be pretty hit or miss, but when you look at the years with the closest fit to 2022, the charts as interpreted by Larry Williams suggest the rest of the year is looking pretty darn good. Despite what we went through last week, he's a buyer, not a seller. And don't forget, a little bit of October turbulence, but we want to buy. That too. Kyle in Illinois. Kyle.
Jim, help me out with Kohl's. I own a large position, right about $28, and at 37 before the earnings, I thought I was fine, and then it just looked like they pulled a Walmart and just guided everything down.
Yeah.
Now I already own TJX, which has been terrific. I got a dividend right around the corner. Number one, is it safe? And number two, what do you recommend at these prices when I have a large position I'm trying to scale out of it?
Okay, I don't trust Kohl's. I don't think they had a good quarter. I went through the quarter. They have inventory galore. They did say they'd stand by the dividend. I didn't like that because I don't want to hear out, but the company standing by the dividend. I think that it could go back to above 30, and above 30, sir, I have to say, I would cut back my position. Let's go to Matt in Wisconsin. Matt.
Jim, booyah. Thanks for having me on.
What's going on?
I'm talking about AbbVie. It's come down big since April with the impending patent cliff on their mega drug Humira.
Right.
But at the same time, they've finished their acquisition of Allergan and Botox, and they're generating cash flow hand over fist. I feel like they could use that cash to make another acquisition and supercharge their pipeline, but I'm not sure that's a great reason to own the stock. So should I sell, hold?
No, I think Richard Gonzalez done. I thought this is a great question. My Charitable Trust owns it. We write about it constantly. Jeff Marks and I, we both believe in it. It's got a 4% yield. We're not that worried about the patent cliff. They are plenty insulated. They have a lot of cash, and I think you stick with AbbVie. Right, when you look at the years with the closest fit to 2022, the charts, as interpreted by the great and legendary Larry Williams, suggests that even after what we went through last week, the rest of the year is actually looking pretty darn good, except for a little bit of an October problem. He'd be a buyer right now, not a seller. Watch more in Mudhead, including my take on Snowflake. Could the data kingpin continue to bring a blizzard to Wall Street? I'm digging into the details. Then, I think it's time to have a serious conversation about the impact of working from home on corporate America. I don't think you'll like what I have to say, but I'm going to give you my take on the situation anyway. I don't do it to please. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer.